Hello and welcome to this important discussion that's brought to you by My Tax Accountant.
Yes, my tax accountant is the UK's leading accounting firm, and you know they're the best when it comes to helping you plan for a comfortable retirement, which is what we're diving into today.
Yeah, it's something that we all think about as we approach those retirement years.
Smart tax planning.
Smart tax planning. Yeah,
It's essential here in the UK.
it is. It is. So what we really want to do today is give you that essential knowledge of how to navigate this maze that is the UK tax system so you can make the most of your retirement, especially with the new rules coming in for the 2025-26 tax year.
Exactly. Retirement is all about enjoying yourself, right? And we want to make sure you keep as much of your hard-earned money as possible.
Working for you, right?
Absolutely. It's not about avoiding tax. That's not what we're saying.
No.
It's about understanding the system.
Yeah.
So you can make savvy decisions.
Informed decision.
Informed decisions, yes, because, let's face it, taxes are a fact of life.
They are.
They don't just disappear when you stop working. They
Right.
just change form
Yeah.
across your pensions, your savings, and any other income you might have.
Exactly right. And what makes this conversation so important right now is that as we head towards 2025, this tax planning is becoming more and more important, wouldn't you say?
Absolutely.
We're seeing frozen tax thresholds, the cost of living is going up,
It is.
and this could mean that more retirees are going to end up paying more tax than they need to.
Exactly. And without even realizing it, their real income might not have actually increased much, but they're still getting pushed into higher tax brackets.
So really, let's just get down to brass tacks. Let's unpack this, starting with the UK tax system
Yeah.
for the 2025-26 tax year.
Okay, sounds good. Let's start with the basics, the personal allowance.
Okay, so the personal allowance, what is it? What does it mean? How does it affect my retirement income?
So for 2025-26, it's staying at £12,570. This is the amount you can earn each year from all your different income sources, your pension, any part-time work, interest from savings, you name it.
Right.
And the best part, you don't pay a single penny of income tax on that.
That's my tax-free bit.
Exactly. Now, here's the catch.
Okay.
This threshold has been frozen since the 2021-22 tax year,
Oh, okay.
and it's not going to change until April 2028.
Right. So it's my tax-free buffer up to that 12,570 pounds.
Yeah,
But what happens when I go over that?
that's when the tax bans come into play.
Okay.
So in England, Wales, and Northern Ireland, you've got a tiered system.
Right.
First, you've got the basic rate of 20% on income up to 50,270 pounds.
Okay.
Then you move to the higher rate, 40%, on anything between 50,271 mon and 125,140 pounds.
Right.
And if you're lucky enough to earn over 125,140 pounds, you hit the additional rate of 45%.
Okay.
And just a quick heads up to our Scottish listeners, your tax bands are slightly different, so make sure you check the specific rates for Scotland.
You mentioned earlier that term fiscal drag.
Yes.
Can you unpack that for me? Because it sounds a little bit scary and technical.
Okay, so imagine you're on one of those moving walkways at the airport, right? You're just glide along, and then suddenly it stops. You keep moving forward a bit because of momentum, but the walkway isn't moving anymore. That's kind of what fiscal drag is like. Your pension income might increase a little each year just to keep up with the rising cost of living, but those tax thresholds, they're staying put. So even though you're not really better off, more of your income is creeping into those higher tax brackets.
It's kind of like being penalized for just trying to keep up, isn't it?
Exactly. And the Office for Budget Responsibility, they've actually predicted that this fiscal drag could lead to something like 7 million people paying higher rate tax by 2025-26.
Wow. Okay. So that's a lot of people potentially paying more tax than they need to. So even if my pension goes up a little bit, a bigger chunk of it could end up going to the tax man. What if I still have some ties to my business, even though I'm retired? Like if I'm drawing dividends, how does that all work?
Okay, so for business owners, it gets a bit more complicated.
Okay.
Any income from dividends or any profits they take out of the business, those can also add up and push them over these important thresholds.
Yeah.
And one threshold to watch out for is £100,000.
Right.
Once your income goes over that, your personal allowance starts to shrink.
Right.
It goes down by £1 for every £2 you earn over that limit. So by the time you hit 125,140 pounds, your personal allowance has vanished completely.
So it just disappears. Poof. It's gone.
Gone. It's a real cliff edge.
Yeah, okay. So earning even a little bit more than 100,000 pounds can really hit you hard in the tax department. What about national insurance? Is that still something I need to worry about in retirement?
Okay, so here's some good news. Once you reach state pension age, which is 67 right now,
Oh,
you generally don't have to pay national insurance anymore, even if you decide to keep working.
oh, okay.
There is one exception, though. Employers still have to pay Class 1A national insurance on any benefits they give you.
Got it. So national insurance isn't really a direct concern for most retirees.
Mhm.
Now let's talk about savings. I know a lot of people rely on the interest from their savings to top up their pension. What do they need to know about tax on that?
Right. So here's where the personal savings allowance, or PSA, comes in. If you're a basic rate taxpayer, you can earn up to £1,000 in savings interest each year without paying any tax on it.
Yep.
If you're a higher rate taxpayer, that allowance drops to £500. And if you're in the additional rate band, you don't get any personal savings allowance at all.
Right.
So let's say your pension income already puts you in the basic rate band and you earn, say, £1,200 in interest from your savings. Well, you'd have to pay income tax on that extra £200 at your basic rate.
So you only pay tax on the amount over your allowance.
Exactly.
Okay. Now what about income from dividends? I know that's changed a bit recently.
Yeah, it has. The dividend allowance has been going down. For 2025-26, it's down to £500.
Yeah.
That's half of what it was in the 2023-24 tax year. And any dividend income you get above that £500 limit will be taxed based on your income tax band.
It seems like there's a lot to keep track of. So
Sure.
understanding these basic rules is like step one in making sure you're not paying too much tax in retirement.
Absolutely.
Now let's talk about something that can really trip people up when they first start taking money out of their pension.
Okay.
The emergency tax trap. What is that?
So the emergency tax trap happens when you take your first taxable lump sum from your pension. HMRC doesn't know how much you're going to earn for the whole year yet.
Right.
So to be safe, your pension provider often uses an emergency tax code.
Okay.
You might see something like M1 on your payslip.
And what's the problem with that?
Well, these emergency codes basically assume that you'll get the same amount every month for the rest of the tax year. So if you take out a big lump sum, they think you'll get that much every month, and you end up paying way too much tax.
Oh, wow. So it's like they're assuming you're going to keep taking that same big amount out every month.
Exactly. And this can be a real problem, especially with those larger withdrawals. We had a listener contact us recently, Jane from Leeds.
Oh, what happened to Jane?
Well, she retired and took out a £50,000 lump sum from her private pension. Now, 25% of that was tax-free, but the rest got hit with this emergency tax code. You know how much she overpaid.
How much?
£8,000.
Oh, my goodness. 8,000 pounds? That's a huge amount of money.
It is. It wasn't until she got in touch with HMRC that she got that money back.
That's a lot of money to be out of pocket. It really shows how important it is to know about this emergency tax crap. Is that a common thing? Or was Jane just unlucky?
No, it happens a lot, unfortunately. HMRC's own data shows that over 300,000 retirees got caught by this in a recent year, so it's definitely something everyone needs to be aware of when they start taking money from their pension.
Okay, so let's say someone's in Jane's position. They've just taken a lump sum from their pension, and they think they've been put on this emergency tax code. What should they do?
Right, so there are two main things you can do. First, get in touch with HMRC directly. Give them a call on 0300 200 3300 and explain that you've been taxed under an emergency code. They can look into it for you. Or you can go online and claim through the gov.uk website. You need to fill out Form P55, which is specifically for getting back overpaid tax on pension lump sums.
Okay, so you got to be proactive about it because they won't just automatically refund you.
Exactly. You have to claim it back.
Right. And how long does it usually take to get that refund?
Once HMRC's processed your claim, it usually takes about 4 to 6 weeks.
Okay, so you do get the money back eventually.
You do.
But 4 to 6 weeks is still a long time to wait, especially if you're relying on that money.
Yeah, it can cause some unexpected problems.
Okay, so the message is clear. Watch out for that emergency tax code when you take your first pension withdrawal, and if you think you've been put on it, act fast. Now let's talk about some important dates and deadlines for the 2025-26 tax year that retirees need to know about.
Okay, so first up, the new tax year always starts on the 6th of April.
Okay.
So that's 6 April 2025. That's when all those new tax thresholds and allowances we've been talking about come into effect.
Right. And what about those retirees who have to fill out a self-assessment tax return?
So if you need to do a self-assessment, the deadline for submitting it online for the 2024-25 tax year is 31 January 2026.
Okay.
This might apply if you're making extra pension contributions to get tax relief, or if you're claiming back overpaid tax from previous years, or if you've got other income that isn't taxed at source.
And of course, we can't forget the end of the tax year.
No, that's another important one. The 2025-26 tax year finishes on 5 April 2026. This is a good time to review your finances and see if you can do anything to optimize your tax position before the year ends.
We talked about business owners earlier. Are there any specific deadlines they need to keep in mind, even if they're retired?
Well, if they're still drawing a salary or dividends from their company, they'll still have to meet those regular PYE and self-assessment deadlines. The exact dates will depend on how their income is being reported.
So whether you're a business owner or not, keeping track of those key tax dates is really important for staying on top of your finances.
Absolutely.
Now, let's go back to something we touched on before that can really affect people with higher retirement incomes.
Okay.
The over £100,000 personal allowance cliff.
Yes, this can be a real hidden danger. As we said, if your total income goes over £100,000, your personal allowance starts shrinking. You lose £1 of allowance for every £2 you earn above that limit. So by the time you get to £125,140, your personal allowance is completely gone.
And that can lead to a much bigger tax bill than you were expecting.
Exactly. People don't always realize how much this can affect them. They might be focused on the standard tax brackets, but not realize that their personal allowance is being reduced as well.
You gave us an example earlier about Mike from Manchester.
Yes, Mike. He's 68, a former company director, and his total income was £110,000 in a recent tax year. That was made up of £70,000 from his pension and £40,000 in dividend income. Because his income was £10,000 over the £100,000 limit, his personal allowance was reduced by £5,000,
And that meant he had to pay an extra.
about £2,000 in tax.
Wow. So it's not just a small difference. It can really add up. So what can people do if they're approaching that £100,000 income level?
Well, one thing to think about is how much you take out of your pension and when you take it out. By managing those withdrawals carefully, you might be able to keep your income just under that £100,000 limit.
Right.
That means you won't lose any of your personal allowance. It might involve taking smaller amounts over a longer period rather than big lump sums all at once. Of course, the best approach depends on your individual circumstances.
So it sounds like understanding the UK tax system, being aware of those emergency tax codes, knowing the important deadlines, and especially understanding how earning over £100,000 affects your personal allowance are all crucial for making sure you're not paying more tax than you need to in retirement.
Absolutely. And by taking the time to understand all of this, you can make smart decisions about your income and make sure you're keeping as much of your hard-earned money as possible.
And if you want personalized advice, the experts at My Tax Accountant are here to help. They can work with you to develop a plan that fits your unique situation. So don't hesitate to reach out to them. Thanks for joining us for this important discussion about UK retirement tax. We hope you found it helpful.
Yes, we hope this has helped you feel a little more prepared and confident about managing your finances in retirement. Remember, proactive planning is key.